Next, we're going to discuss complex trust taxable income. So these tax rules for complex trust are similar to those for estates. Calculation of taxable income calculation for complex and simple trust is similar, but the distribution deduction and personal exemptions differ between the two. The distribution deduction for a complex trust is the sum of the total current income required to be paid out currently plus other amounts properly paid or credited or required to be distributed to the beneficiary during the year. So remember, with complex trust, they're not required to pay out all their income every year. So what this is saying is that the distribution deduction is equal to what they are required to be paid out plus anything else they paid out properly per the trust instrument or credited to the beneficiary during the year. Distributable net income is not reduced for charitable contributions when determining maximum distribution deduction for mandatory distributions, but it is reduced for charitable contributions when calculating the deduction for discretionary distributions. The tax rules for the beneficiary are as follows. The amount of the distribution is generally included in the beneficiary's gross income, and we define that amount as the sum of the income required to be distributed currently plus any other amount properly paid or credited or required to be distributed to the beneficiary during the year. Tax-exempt income, of course, is not reported in the beneficiary's gross income, and it's calculated by taking a portion of the distributable net income that is tax-exempt. So we look at all the distributable net income and we look at the tax-exempt portion, and we see what portion that composes, what portion the tax-exempt income composes. Maybe it's 10% of DNI, and so a beneficiary will exclude 10% of the income they received as tax-exempt income. If a mandatory payment to a beneficiary exceeds DNI, each beneficiary reports as gross income the following ratio of DNI attributable to taxable sources. It's in the numerator the income required to be distributed currently to this beneficiary divided by the aggregate income required to be distributed to all beneficiaries. This fraction tells them the ratio of the payment they receive that will be taxable. There are some exceptions to that general rule we just talked about. The first is going to be the tier system. If a trust is requiring mandatory distributions to some beneficiaries, but not all, so mandatory to some, discretionary to others, and if distributions exceed distributable net income, Tier 1 beneficiaries are the first to absorb income, and Tier 1 beneficiaries are those who receive mandatory distributions. So Tier 1 beneficiaries are taxed on the lesser of aggregate mandatory distributions, or DNI. And then if the required income distributions plus other distributions exceeds DNI, each Tier 2 beneficiary includes a fraction of the remaining DNI in income. And it is calculated like this. So this is the same fraction as we saw a couple slides ago. The numerator is the income required to be distributed currently to this beneficiary, and they divide that by the aggregate income required to be distributed to all beneficiaries. And that we apply that ratio to the Tier 2 distributions to determine what portion is taxable. Another exception is what we call the separate share rule. And this rule is going to apply to trusts and estates with governing instruments that require that distributions be made in substantially the same manner as those separate trusts had been created, even though they have not. So a trust for one trust that governs distributions to siblings, maybe. And in calculating the trust taxable income, these trusts are treated as single taxpaying entities, even though they portend to be separate trusts. And the final exception we're going to talk about is specific bequest. Distributions of principal from a trust or estate may carry out with them distributable net income and therefore be included in the beneficiary's income. But distributions from a specific sum of money or of a specific property required under a decedent's will do not carry out DNI and are therefore not taxable to the beneficiary, but they're taxed at the estate level. So specific bequest and a will are going to be taxed at the estate level, not at the individual beneficiary level. If we have a net operating loss, it's treated the same as it was for a simple trust generally, and it carries over to a subsequent year. In the year the trust or estate terminates, any remaining NOL passes through to the beneficiaries. And then if we have a net capital loss, again, we can deduct the lesser of $3,000 or the excess of capital losses over capital gains. Here we have a complex trust. It is authorized to make discretionary distributions of income and principal to its two beneficiaries, Roy and Sandy. Separate shares are not required. For the current year, it has D&I and net accounting income of $80,000, all from taxable sources. It distributes $60,000 to Roy and $40,000 to Sandy. How much gross income should each beneficiary report? So remember, D&I is going to represent the maximum amount that our beneficiaries will be taxed on. So our D&I in this problem is $80,000, but we see that $100,000 is distributed. So we are going to have to allocate that $80,000 of taxable income between Roy and Sandy, and the rest they will receive tax-free. All right, and we're basically going to allocate it proportionate to the amount of distribution they received. So Roy received $60,000 of the $100,000 distribution, and Sandy received $40,000 of the $100,000 distribution. So those are going to represent our fractions. And then we're going to multiply those fractions by the amount we want to allocate, which in this problem is $80,000. So Roy is going to report $48,000 of income from this distribution, and Sandy is going to report $32,000. Now refer to problem 35, which is the one that we just did. How would your answers change now if the trust instrument required that $10,000 per year be distributed to Sandy, and the trustee also made discretionary distributions of $60,000 to Roy and $30,000 to Sandy, with separate shares not required? Okay, we've still distributed $100,000, and our D&I is still $80,000. So the total amount that is going to be taxable to our beneficiaries is $80,000. But now we have some beneficiaries receiving mandatory distributions and some discretionary. So this is the tier system. And here we have Sandy as a tier 1 beneficiary because her distribution of $10,000 is mandatory. The remaining distributions are tier 2 distributions, and you'll notice that Sandy also gets a tier 2 distribution, and that happens often. That is allowed. So first we'll allocate the tier 1 to Sandy, so the $10,000 to Sandy, and that is going to be taxable to her. So she gets that tier 1 distribution. Now we need to allocate the tier 2 distributions, the discretionary distributions. Of the tier 2 distributions, there's a total of $90,000. So we'll do the same thing that we did before, except our denominator is 90. And so of the tier 2 distributions, Sandy received $30,000 and Roy received $60,000. And so we are going to, that is going to be our fraction. And then we're going to allocate the total the total D&I less what we have already allocated. So $80,000 of D&I minus the $10,000 we've already allocated to Sandy. So our fraction will be $70,000 times $30,000 divided by $90,000 for Sandy's tier 2 distribution, which is $23,333. And then Roy's tier 2 distribution is $70,000 times the fraction $60,000 divided by $90,000 to allocate $46,667 of taxable income to Roy. All right, the next topic we're going to cover is income in respect of a decedent. This is gross income that a decedent earned prior to his death or her death, but that was not includable in computing taxable income for the year ending on the date of death or for an earlier tax year under the accounting method employed by the decedent. This might be income that, say we have a cash basis taxpayer and the taxpayer earned the income, but the income wasn't paid until after death. This is going to be included in the decedent's estate and the income tax returns of the estate, trust, or beneficiary as they are collected. They are allowed deductions, so deductions in respect of a decedent are going to include trade or business expenses for the production of the income taxes, interest, depletion, etc. that have accrued prior to death but are not deductible on the decedent's final return because of the accounting method. And these expenses are going to be deductible as debts on the estate tax return. For any estates that might owe taxes, a deduction will be allowed for estate taxes attributable to an item of income in respect of a decedent. The amount of the deduction is going to be the excess of the decedent's actual federal estate tax over the federal estate tax that would be payable if the item of income in respect of a decedent was excluded from the decedent's gross estate. Most of the property received as the result of a decedent's death acquires a step-up in basis, or a basis equal to its fair market value on the date of death, which we have discussed. But if we have property that is classified as income in respect of a decedent, it retains the basis it had in the decedent's hands, so they do not get that general step-up in basis. We also might have grantor trust. In a grantor trust, the rules that govern a grantor trust are designed to make grantors who do not give up enough control or economic benefits when they create a trust to be taxed on all or part of the trust income. A grantor, so the creator, a grantor is generally taxed on the trust accounting income if the trust property will return to the grantor or the grantor's spouse. This includes the following types of trust. A revocable trust, so if it's going to revoke and the income and the principal is going to revert back to the grantor. A post-1986 reversionary interest trust. Here, if the grantor holds the reversionary interest, so when the trust terminates, the property reverts back to the person who holds the reversionary power. If the grantor holds that, then it's going to be taxable to the grantor. If the grantor retains administrative powers or retains economic benefits, then the accounting income is going to be taxable to the grantor. And if the grantor retains the right to control others' enjoyment of the trust property, then the income will be taxable to the grantor.